you just spend a little bit less than you earn. And you can spend a little bit more than you earn, and then you've got debt, and the chances are you'll never get out of debt. I'll make an exception in terms of a mortgage on your house, but credit card debt, we're in the credit card business big time, and the world will stay in the credit card business. But why get behind the game? And if you're effectively paying 12 or 14 or whatever percent you're paying on a credit card, you're saying I'm going to earn more than 12 or 14% on money. And if you can do that, come to Berkshire Hathaway.
This is Warren Buffett. He's a billionaire investor and chairman of Berkshire Hathaway, his company, which holds a lot of assets, including a portfolio of publicly traded companies. One of the most profitable holdings in the company is American Express, which is a financial services provider that is popular for its credit cards, which many people have and use on a daily basis. This is a very profitable company. So why on earth would Warren Buffett warn you against something that is essentially making him money? Welcome to The Eighth Wonder, a channel dedicated to making compound interest your best interest. The clip you just saw is from a recent shareholder meeting where Warren was asked about major mistakes to avoid in investing and in life. And that was his response. The truth is, with inflation being so high, the average price of goods and services continues to rise faster than most household incomes. Many people have turned to the use of credit cards to cover their outstanding expenses. But the unfortunate part about this is that interest rates are also high because the government is trying to bring down inflation by raising rates. By using a credit card, you are able to get whatever it is that you want at the time, which is very convenient. But as another billionaire investor, Ray Dalio, once said, this is simply borrowing from your future self. So those repayments will come due, and when they do, they will do so with interest. So let's take a look at credit cards and what they are all about and why Warren Buffett warns us about them. A credit card is issued by a financial institution such as a bank or credit card company, and it allows individuals to make purchases on credit. It essentially acts as a revolving line of credit, enabling cardholders to borrow money up to a predetermined credit limit set by the issuer. When you use a credit card for a purchase, the card issuer pays the merchant on your behalf, and you are obligated to repay the issuer for the amount spent. Unlike a debit card, which deducts funds directly from your bank account, a credit card allows you to borrow money and pay it back at a later date. Credit cards offer convenience and flexibility as they can be used for in-person and online transactions globally. They are also widely accepted by merchants, making them a popular payment method. In addition to facilitating purchases, credit cards often come with various benefits and features, including rewards programs, cashback offers, travel insurance, purchase protection, and fraud protection. These perks vary depending on the specific credit card and issuer. So far, credit cards seem pretty harmless and even desirable, right? Well, here are some important things you need to know about credit cards. Number 1. Credit card billing cycle. This is a specific period during which all the transactions made with your credit card are recorded. It usually lasts between 28 to 31 days, but the exact duration can vary depending on your credit card issuer. During the billing cycle, any purchases, cash advances, balance transfers, fees, and interest charges are recorded and associated with a specific period. It's important to understand the timing of your billing cycle as it determines the transactions included in your upcoming credit card statement. Number 2. Credit card statement. At the end of each billing cycle, the credit card issuer generates a statement which provides a summary of your account activity for that specific period. The statement is typically made available to you electronically through an online portal or sent via email. It contains important information regarding your credit card usage and payment details. Now, the following points are elements that will be found on your credit card statement. You need to understand these because they are factors that make all the difference. Number 3. Minimum payment and due date. The minimum payment is the amount required for that billing cycle and is typically required to be paid by a certain date, usually the end of the cycle. It is usually a small percentage of the total outstanding balance, typically around 2 to 3%. Paying at least the minimum payment by the due date keeps your account in good standing, although paying the full statement amount is generally recommended to avoid interest charges. This is a very important concept to understand. Failing to do so will result in you being trapped in a very unpleasant financial situation. It is good to make the minimum repayments on time every time. This will help build up your credit score, which I made a video about a while ago, and the link to it is in the description and in the pinned comment. As much as making the minimum repayment amount will keep your account in the green, it will still mean that you owe the balance, and this will work against you, which brings me to number 4, finance charges. If you carry a balance on your credit card and do not pay it off in full by the due date, interest charges or finance charges may apply. The statement will indicate the amount of interest accrued during the billing cycle based on the annual percentage rate or APR on your credit card. The average APR is about 20%. This means that even though you are making your minimum repayments on time, you'll still accrue a lot of debt due to the fact that you haven't paid the full amount. For example, let's say you have a credit card with a balance of $2,000 and an annual interest rate of 18%. The minimum payment required is 3% of the outstanding balance, or $25, whichever is higher. At the end of the billing cycle, you receive a statement indicating that your minimum repayment is $60. If you choose to make only the minimum payment, the remaining balance will be $1,940, which carries over to the next billing cycle. Since you didn't pay off the full balance, the credit card company will charge interest on the unpaid amount. Assuming the interest is compounded monthly, the interest for the next billing cycle will be calculated based on the average daily balance for that period. Let's say the next billing cycle is 30 days long. The average daily balance is calculated by adding up the daily balances and dividing by the number of days in the cycle. Assuming that you didn't make any additional purchases or payments during this period, the average daily balance would be $1,940. Using the annual interest rate of 18%, the monthly interest rate would be 1.5%, which is 18% divided by 12 months. Therefore, the interest charge on this billing cycle would be $29.10. At the end of the second billing cycle, your new balance would be $1,969.10. If you continue to only make the minimum payment, the cycle of accruing interest on the remaining balance would continue, and it would take a long time to pay off the debt if you don't make larger payments or pay the balance in full. It is important to note that the numbers used in this example are for illustrative purposes only. The actual credit card terms and conditions may vary. So as much as making minimum payments helps with building up a credit score, this approach will lead to building up your debts too. This is one of the biggest reasons why Warren Buffett warns against credit card debt. When interest rates rise, so does the APR on your credit card. So unless you pay your balance in full before the end of the cycle, you'll be liable to pay the interest accrued. By only making the minimum repayments, you are keeping the credit providers in business because they keep making money off you. Earlier this year, Warren Buffett released a letter to the shareholders of Berkshire Hathaway, which I made a video about a while ago and is also linked in the description and the pinned comment below. In that letter, Warren talked about two of the greatest investments Berkshire has made. This is what he had to say. In August 1994, yes, 1994, Berkshire completed its 7-year purchase of the 4 million shares of Coca-Cola we now own. The total cost was $1.3 billion, then a very meaningful sum at Berkshire. The cash dividend received from Coke in 1994 was $75 million. By 2022, the dividend had increased to $704 million. Growth occurred every year, just as certain as birthdays. All Charlie and I were required to do was cash Coke's quarterly dividend checks. We expect that these checks are highly likely to grow. American Express is much the same story. Berkshire's purchase of Amex was essentially completed in 1995 and coincidentally also cost $1.3 billion. Annual dividends received from this investment have grown from $41 million to $302 million. Those checks too seem highly likely to increase. These dividend gains, though pleasing, are far from spectacular, but they bring with them important gains in stock prices. At year-end, our Coke investment was valued at $25 billion, while Amex was recorded at $22 billion. Each holding now accounts for roughly 5% of Berkshire's net worth, akin to its weighting long ago. My purpose in sharing this clipping from the letter is to show you just how much credit card companies are making off people's mismanagement of credit cards. Warren notes that the dividend income they receive from American Express is expected to rise even higher, which just goes to show how profitable of business Amex is. People keep digging themselves deeper and deeper into debt, which can take a long time to pay back and be in the clear. The opportunity cost for this is far too great for people to ignore. For someone like Warren Buffett, who benefits directly from people's mistakes, to come forth and warn people against credit cards, it means that he really feels for the people who are in debt and is aware of how bad the situation is. If nothing gets done, the situation will only get worse. Number 5. Credit limit and available credit. Your credit card's credit limit, which is the maximum amount you can borrow, is mentioned on the statement. It also provides information about your available credit, which represents the remaining credit limit you can still use for new purchases. For a good credit rating, you are advised to keep your usage under 30%. This way, you should be more able to make repayments in full, which will rid you of debt, but will also contribute towards building your credit record. By spending all the money available to you on your credit card, you not only mess up your credit rating, but you're also accruing bigger repayments. Number 6. Rewards and benefits. Many credit cards offer reward programs such as cashback, travel miles, or points for eligible purchases. These rewards can be redeemed for various benefits such as discounts, gift cards, travel, or statement credits, depending on the credit card's terms and conditions. These are some good incentives that encourage people to use credit cards and can be very beneficial if you manage your credit card right. It is important to note that the rewards programs will only benefit you if you're making your full repayments. Otherwise, as one friend of mine likes to say, the house always wins. So you'll notice that I gave you both pros and cons of using a credit card. I believe that a credit card is not necessarily a bad thing. It just requires a lot of discipline, which is what most people lack, and what leads them to end up with piles of debt. It is no secret that a credit card is one of the easiest ways to build up your credit score and has a bunch of nice benefits to it. But in order to enjoy all these things, you need to make sure that the money you spend on your credit card is money that you already have and can easily pay back at the end of the billing cycle, and making sure that you make those payments on time. This way, you end up pretty much getting paid for using your credit card. If you're watching today and have already dug yourself into debt, then I would recommend that you follow one of the two most popular methods for eliminating debt, the snowball or avalanche method. In the debt snowball method, you focus on paying off the debt with the lowest balance first, while making minimum payments on your other debts. This approach helps you see progress and build momentum as you pay off each debt. The debt avalanche method focuses on paying off the debt with the highest interest rate first, which is the most efficient way to minimize the amount of interest you pay. Whichever method you choose, it is important to have a plan in place, stay disciplined, and adjust your spending habits to free up more money to put towards your debt repayment. Debts have a big influence not only on individuals but on countries too. Warren Buffett, Charlie Munger, Ray Dalio, Peter Lynch, and a whole lot more have spoken on this topic. Check out my playlist with videos from these great investors to learn more about what they had to say. I hope that you learned a thing or two from this video and that you'll make good choices that will keep you afloat during these times of financial turmoil. Is there anything that I missed? Comment below and let me know. Feel free to also share your thoughts on credit cards and their impact on people and countries' finances. If you found value in this video, then show some love by leaving a like and sharing it with a friend. Subscribe to the channel if you haven't done so already, and click on the notification bell to stay up to date with all the great lessons shared on this channel. Thanks for watching. Hope to see you on the next one. But until then, stay invested.